Foreign investors are selling US Treasuries. Today, I'll explain what that really means for the US dollar and your portfolio. Let's get right into it. First, don't be tricked by the government headlines that inflation is cooling. Recently down to 3.4% and consumer prices are down. There are literally no standards to this data. Just look at some of the changes they've made to the CPI or Consumer Price Index methodology in 2025. You can't even compare the CPI numbers this year to last year's, yet alone 3 or 4 years ago. Instead, you all know that we focus on the fundamentals here. The true value of money is not just an index or a price change. It's the purchasing power of the US dollar. And I think a clear statistic that really shows that is home ownership. Just 33% of 30-year-olds in the US own homes today versus 47% in 1984. I mean, this is a big difference. That is a lot less people that can afford homes today versus 30 or 40 years ago. Even if you look at the average age of first-time home buyers, it is today 38 years old versus 29 years old in 1981. This is not a function of people not wanting homes, it's affordability. So when you see reports claiming that inflation is cooling from 3.5 to 3.4%, you have to look at the fundamentals. It's the purchasing power of the US dollar going up. Is housing becoming more affordable for the majority of the population? Is the cost of college and healthcare still increasing at a much faster rate than wages? Well, yes, it is. Let's follow the money. What has been happening concerning the US dollar, which was historically considered a reserve asset? So when looking at some of the top foreign holders of US debt, and a matter of fact, Japan is the number one foreign holder of US government debt. And when I say this number about Japan, it's Japan as a country, not just the government of Japan. So it includes the Bank of Japan, the Ministry of Finance, and Japan-based pension funds, banks, and private investors. So you can see that the amount of US government debt that Japan holds has fallen from 1.15 trillion to around 1.12 trillion, a 3% or almost $40 billion drop from June 2025 to June 2026. UK, the second biggest holder of US foreign debt, is up 10% or around $95 billion. While others like China, the number 3 holder, is rapidly getting rid of US government debt, down 13% over the same period, holding around $100 billion less in US treasuries than it did last year. While it's important to watch each country, it's also important to analyze the total amount of all foreign debt. And not just the amount, but the proportion of total US debt held by foreign holders. Let me explain. So you can see the total foreign debt is up 2.3% from June 2025 to June 2026, or around $205 billion, right? But let's look up here. And we can see how that percentage has changed over time. When it was 9.09 trillion, foreign investors held around 25.1% of all US national debt. Today, US national debt has reached $40 trillion, and foreign investors only hold around 9.3 trillion, which means foreign investors are holding 23.6% of US debt. So foreign investors' percentage of US debt has gone from 25.1% to 23.6% in just 1 year. What does this mean? It means that the US is issuing more debt at a faster pace than the international demand for its debt. So foreign investor demand can't keep up with how fast the US government is creating more debt. So foreign investors are pulling back on US treasuries, while at the same time, the interest rate on US treasuries is increasing rapidly. Since 2020, the 30-year treasury bond rate has gone from around 1.2% to today over 5%. This has vastly increased the cost of borrowing for the US government. Higher interest rates means investors are demanding a higher yield because they expect longer-term inflation to be higher for the US dollar, and therefore won't buy US treasuries unless they feel the interest rate can cover that inflation. So if you have the US government, how do you solve this problem of rising rates? Well, you just buy back your own debt. the U.S. Treasury just announced government debt buybacks on longer duration bonds. By longer duration debt, the U.S. government is specifically targeting the 10 to 20 year and the 20 to 30 year maturities. To note, the U.S. Treasury was already buying back its own debt, but this announcement will double the amount that they are buying from $2 billion per operation to at least $4 billion per operation. And let me make it clear that this overall change is just in the allocation of the U.S. government debt profile. They are simply issuing short-term U.S. debt to buy back longer-term U.S. debt. So just imagine the U.S. government using treasury bills of 3 months to 1 year to buy back treasury notes or bonds at 10 years plus. The total debt stays the same, but the maturity profile changes. Even more troubling is that after doubling the buyback amount for longer duration debt from $2 billion to $4 billion, the U.S. Treasury Secretary is now saying that buybacks will exceed even $4 billion. And this announcement just came 1 day later. This shows that there are perhaps extreme demand issues with those longer term U.S. Treasuries. Now, the claim is that there has been a buyer's strike of longer term U.S. government debt since June, specifically of investors not wanting to buy this longer term U.S. debt. In response, the U.S. Treasury is stepping in to provide liquidity support. This ensures that people who want to sell the 10-year or the 20-year or the 30-year U.S. Treasuries will be able to easily. The U.S. Treasury wants to stop this buyer's strike, which would essentially slow or reverse the rising yields on that longer-term debt. It's all about supply and demand. If you increase the demand for U.S. Treasuries, you increase the price, which lowers the interest rate. So companies will have much cheaper interest rates on debt they need to expand. People will have much cheaper interest rates on their mortgages or student loans. It essentially makes the cost of economic growth cheaper. While this will supposedly boost economic growth, the two questions you need to be asking is that number one, why are foreign investors pulling away? And number two, why are investors in general pulling away from these longer term U.S. Treasury securities? It's important to know that owning U.S. Treasury signifies faith in the U.S. government and faith in the U.S. dollar. Because as an investor, you believe that the interest rate you will get on that U.S. debt will exceed inflation. If the U.S. government is stepping in to buy 10 to 30-year treasuries because there's no demand, that essentially means that investors have a pessimistic view of inflation over the next 10 to 30-year periods and don't feel that U.S. government bonds interest rates will adequately compensate them for that higher expected inflation. So things are not looking good for the U.S. dollar. Foreign investors are pulling back and there's a lack of liquidity for U.S. debt. So what about your portfolio? How do people respond in times of higher expected inflation? Well, they go to assets that serve as good inflation hedges. And we have seen that with gold, for example. It recently went up over 3% in 1 day and is now around $4,500 per ounce. Also, Bitcoin. It's up almost 20% over the past 5 days and is now closing in on $75,000 per token. Bitcoin and gold are both assets that have historically rallied in periods where the dollar is weak. As investors shift funds to assets like these that they feel will serve as good inflation hedges. What's the angle? The US dollar is expected to continue to have inflation. All the data points to this. You have higher treasury interest rates. You have a lack of buyers for longer-term treasury securities. You also have the foreign investors solely reducing the amount of U.S. government treasuries that they own. Investors need to protect the portfolio, and some will rotate their funds into assets that they consider inflation hedges like gold or Bitcoin. But these are my thoughts. What are yours? Let me know in the comments. If you enjoyed this video, believe it has some valuable insights, hit the subscribe button, turn on those notifications, and I'll see you next time.